A very special hello to all of you, my dear friends, and a warm welcome to another exciting and deep educational lesson. Today, we want to talk about one of the most fascinating concepts in advanced market analysis. Let me start with a question. Have you ever felt that to understand the story of a single chart, you are missing a piece of the puzzle? The truth is, markets do not exist in a vacuum. They are all interconnected and are constantly talking to each other in a secret language. The problem is, most traders are only looking at one chart, so they only hear one side of the conversation, missing out on crucial clues. Now, what if you could listen in on this secret conversation? What if you could spot the exact moment when two markets that are supposed to be best friends suddenly start telling two different stories? This is the power of SMT divergence. And today we will learn how to decode this secret language.
This secret language cannot be heard between just any two random assets. It can only be deciphered between two assets that share a deep, almost unbreakable bond. High correlation. Imagine two synchronized swimmers who perform the exact same routine in perfect harmony 95% of the time. Their movements are a mirror image of each other. In the financial markets, certain currency pairs act just like these swimmers. The classic examples are Euro USD and GBP USD. Why are they so correlated? Because both represent major European economies and are priced against the same currency, the US dollar. Their fates are intertwined. Understanding this prerequisite is the first and most critical step. We must first find these, quote, market twins who move in lockstep, because only then will any disagreement between them become a significant and tradable event.
This powerful disagreement between correlated pairs doesn't just show up in one form. It has many faces. A professional trader learns to recognize all of them. This divergence can appear on a grand macro scale, for instance, between the highs and lows of entire trading days. One pair might break the previous day's low while the other refuses to do so, signaling a major potential reversal. It can also appear on an intraday scale, for example, between the highs and lows of the Asian trading session, giving day traders a huge edge at the London Open. And of course, there is the most classic form, which appears between two nearby swing points on the chart. In this lesson, we will explore each of these variations in detail, so you can learn to spot these subtle but powerful patterns in any market condition.
Now for the most exciting part. What happens during that rare 5% of the time when one of our synchronized swimmers zigs while the other one zags? That moment of disagreement, that anomaly, is not a random error. It is the most valuable piece of information a price action trader can get. The theory behind smart money technique, or SMT, is that this divergence is the footprint of smart money. It is believed to be the result of large financial institutions manipulating the market to build their massive positions. For example, they might aggressively push one pair down to hunt the stop losses of retail traders while secretly using that liquidity to accumulate a huge long position in the other correlated pair. This anomaly is our signal that the market's giants are making their move, and our job is to get ready to follow them.
Spotting a divergence is only the first step. Any amateur can see two lines going in opposite directions. The real skill of a professional lies in knowing which divergences to trust and which to ignore. This lesson will not just teach you how to see the divergence, more importantly, it will teach you how to filter it. We will learn why a divergence is only powerful when it happens at a specific location on our chart, like a higher time frame point of interest, and at a specific time of day relative to the daily open. By the end of this lesson, you will have a complete methodology for using SMT not just as a cool observation, but as a core component of a high probability professional trading strategy. You will learn to think like the smart money and see the market through their eyes.
Today we want to delve into one of the most fascinating and advanced concepts in market analysis, a technique known as SMT divergence. What if I told you that sometimes to predict the future of one market, you must listen to the secret whispers of another? This is the core idea behind SMT divergence. It's about spotting a disagreement or a divergence between two markets that are supposed to be the best of friends and move in perfect harmony. This disagreement is our clue. It's a subtle signal that the market's underlying dynamics are shifting, and that a major, powerful move is likely about to happen. This lesson is about learning to hear these secret whispers and use them to our advantage, allowing us to see potential reversals before the rest of the crowd does.
This powerful technique is not something we can apply to any random pair of assets. The first and most important rule is that SMT divergence only works on two assets that are highly correlated, meaning they move together like synchronized swimmers over 90% of the time. The logic is simple. If two things almost always do the same thing, the moment they don't, it becomes a very significant event that demands our immediate attention. So what are the best candidates for this analysis? Typically, we look at major currency pairs that share a common denominator, with the classic examples being Euro-USD and GBP-USD. Since both are traded against the US dollar and represent major interconnected economies, they tend to move in lockstep, making any deviation between them a powerful analytical clue.
Let's think about this more deeply. If two highly correlated markets like Euro-USD and GBP-USD move together 91% of the time, what is happening during that mysterious 9% of the time when their paths diverge? The theory behind smart money technique, SMT, is that this anomaly, this temporary breakdown in their synchronized dance, is the footprint left behind by, quote, smart money. It's believed to be a sign of large institutions accumulating or distributing massive positions. They might be manipulating one market to hunt for liquidity, stop losses, while secretly entering a large position in the other. By learning to spot this divergence, we are essentially learning to spot the tracks of the market's biggest and most powerful players, allowing us to align our trades with their immense force.
So what does this divergence actually look like on the charts? Let's start with the bearish version. Imagine both Euro-USD and GBP-USD are in a strong, healthy uptrend, making a series of higher highs and higher lows. Suddenly, one of the pairs, let's say GBP-USD, shows a burst of strength and makes another clear, new, higher high. Logically, we would expect its correlated partner, Euro-USD, to do the same. But when we look at the Euro-USD chart, we see that it has become weak and tired. At the same moment in time, it fails to break its previous high and instead forms a lower high. This is the classic bearish SMT divergence. It is a powerful warning sign that the underlying strength of the overall upward move is fading,
and a major reversal to the downside is now highly probable.
To solidify this pattern in our minds, let's draw the schematic verbally. Picture two charts side by side. On the left, we have the GBP USD chart. We draw a clear uptrend culminating in a distinct new higher high. On the right, we have the Euro USD chart. At the exact same time that GBP USD is making its new high, we draw the price on the Euro USD chart, failing to do so, instead creating a clear lower high. This visual mismatch, this clear break in their synchronized dance, is our high probability signal to begin looking for shorting opportunities. We anticipate a significant price drop because the smarter of the two pairs, the one that failed to make a new high, is signaling that the bullish momentum is exhausted. This visual confirmation is what we hunt for.
Now, let's flip the entire scenario to understand the bullish version of this pattern. Imagine both Euro USD and GBP USD are in a clear aggressive downtrend, making a series of lower lows and lower highs. One of the pairs, let's say GBP USD, continues its fall and makes another scary new lower low, crashing downwards. Logically, its correlated partner should follow suit. But when we look at our second chart, Euro USD, we see something amazing. It has refused to make a new lower low. It has held its ground at a previous support level and has instead formed a higher low. This is the classic bullish SMT divergence. It is a powerful clue that despite the apparent bearishness on the surface, an underlying strength is quietly building and the sellers are losing their power. This is our signal to anticipate a major reversal to the upside.
SMT divergence is a powerful leading indicator that allows us to see potential market reversals before they become obvious to the general public. It's a technique based on finding a temporary but significant breakdown in the high correlation between two major related assets. While it's not a signal that is 100% certain every time, when it appears in the right market context, it provides an incredible edge. The ultimate goal of using this advanced technique is to follow the smart money. When we see this divergence, we are essentially seeing the result of large institutional manipulation or strategic positioning. Our job is to align ourselves with these powerful market forces and ride the wave that they are about to create. This is one of the most sophisticated ways to find a true professional edge in the market.
We have now established the core concept of SMT divergence, a powerful disagreement between two highly correlated assets. But it's crucial to understand that this divergence doesn't just appear in one simple form. It has many faces and can manifest on different scales and between different reference points. The classic version we often see is between two nearby swing highs or lows. However, the market's, quote, smart money leaves its footprints in more subtle ways as well. Today's lesson is about uncovering these other, more nuanced forms of divergence that many traders often miss. By learning to spot these different variations, we give ourselves more opportunities to identify the hidden hand of the market's largest players and to anticipate their next move with greater accuracy and confidence. Let's peel back the layers and explore these advanced patterns.
The first type of divergence we will explore occurs on a larger, more strategic scale, the daily high and low SMT divergence. For this pattern, we use the previous day's high and low as our key battleground. At the start of a new trading day, we watch closely to see how our two correlated pairs interact with these critical levels. Imagine this scenario. Pair A breaks below yesterday's low, showing what appears to be strong bearish intent. This might tempt many traders to sell. But at the exact same time, its best friend, pair B, refuses to follow. It holds strong above its own low from yesterday. This disagreement is a powerful bullish SMT divergence. It's a major clue that the bearish move on pair A is likely a fake out or a liquidity hunt, and that the true underlying strength is to the upside.
Now let's zoom in to an even more granular intraday perspective with our second type, the session high and low SMT divergence. For day traders, the relatively quiet Asian trading session often sets the initial high and low for the day, creating critical boundaries. When the volatile London session opens, we watch these Asian session boundaries like a hawk. Let's say pair A in the early London hours raids the liquidity resting below the Asian session low, making a new low for the day. But its partner, pair B, fails to do so. It respects its own Asian session low and begins to show strength. This is a classic high probability bullish SMT signal for intraday traders. It serves as an early warning that the London session's initial move down is likely a trap designed to fool traders before the real move upwards begins.
The third type is the quote-unquote classic form of SMT that we are most familiar with, the divergence between two nearby swing points. Let's walk through a real-world application. Imagine two correlated pairs, pair A and pair B, both make a significant low point at the same time. After a small bounce, they both pull back down. Now the divergence appears. The quote-unquote stronger pair, pair A, fails to break its previous low and instead creates a higher low. At the exact same time, the quote-unquote weaker pair, pair B, fails to hold support and creates a lower low. This divergence gives us a massive strategic advantage. We now know that the smart money is showing more interest in buying pair A. Therefore, we will choose to place our long trade on the stronger pair and completely ignore the weaker one, even though both might eventually go up.
To ensure this classic pattern is permanently etched into our minds, let's verbally draw the schematic for this bullish divergence. On one side of our screen, we visualize the strong pair. It makes a low point, bounces up, pulls back down, but holds firmly above the previous low, creating a clear higher low, and then begins its ascent. Simultaneously, on the other side of the screen, we visualize the weak pair. It makes a low point along with its partner, bounces up, but then its pullback is much deeper and it breaks below its previous low, creating a clear lower low before it finally follows the strong pair upwards. This obvious visual discrepancy, this break in their synchronized formation, is our A+ entry signal to go long on the stronger of the two assets.
Now let's step back and understand the unifying principle behind all three types of divergence we've discussed. Whether we are comparing daily highs, session lows, or nearby swing points, the story we are reading is always the same. We are measuring the relative strength and weakness between two highly correlated assets. When one asset begins to show signs of strength, example by failing to make a new lower low, while its partner continues to show signs of weakness, example by making a new lower low, this is a clear signal that the underlying market dynamics are shifting. The smart money is beginning to place its bets on the stronger asset. Our job as diligent analysts is to identify the stronger horse in the race and align our own trades with that emerging strength. This is how we use divergence to gain a predictive edge.
Now, beyond these three major types of divergence that are based on clear structural points, there exists another, even more subtle and granular level of analysis. This advanced form of divergence can often be spotted by analyzing the relationship between the bodies and wicks of individual candles on the two correlated charts. It involves looking for discrepancies in how a candle closes relative to its wick, which can signal a very early shift in momentum long before a major structural point is even challenged. This requires an extremely well-trained eye and a deep understanding of candlestick analysis. But that is a deeper, more complex topic for another time. For now, mastering these three main patterns, daily, session, and swing point divergence, will give you a powerful and consistent edge in your trading.
Now that we are familiar with the major types of SMT divergence, let's zoom in to the most granular and subtle level, candlestick SMT divergence. In this type, the divergence doesn't happen between major swing points, but between just two adjacent candles on our two correlated charts. Imagine you are looking at the chart. On pair A, the current candle's low is higher than the previous candle's low. But when you look at pair B, you see that its current candle's low is lower than the previous candle's low. This disagreement between just two candles is also a form of divergence. What is happening here? In reality, this two-candle pattern on our current time frame is actually a complete swing point divergence on a much smaller hidden time frame like the seconds chart. This is the fastest and most immediate form of divergence we can spot.
It is crucial to understand that there is a clear hierarchy of power among these different types of SMT divergence. They are not all equal in strength. The most powerful and significant type of divergence is the one that occurs between the daily highs and lows. Because this divergence is forming on a very high time frame, the move that results from it will likely be very large and sustained. Next in the hierarchy is the divergence between session highs and lows, which is very important for intraday traders. After that comes the classic divergence between two nearby swing points. And finally, the fastest but least powerful form is the candlestick divergence we just discussed. Understanding this hierarchy helps us to manage our expectations. A divergence between daily lows might signal a multi-day reversal, while a candlestick divergence might only signal a small short-term pullback.
Now for the most important warning of this entire lesson. You absolutely cannot trade SMT divergence in isolation. If you just open a chart and look for divergences, you will find them everywhere. The market is full of these small disagreements. If you try to trade every single one that you see, you will face a huge number of losses and will quickly become frustrated. Why?
because SMT divergence is not a complete trading strategy in itself. It is a confirmation tool. It is a powerful piece of evidence, but it is just one piece of the puzzle. To use it effectively and profitably, we must combine it with other powerful filters to weed out the low probability signals and focus only on the A+ setups.
So what is the first and most important filter we must apply? A divergence only becomes truly meaningful and tradable when it forms at a specific high-value location on our chart. That location is a pre-identified higher time frame point of interest, POI. This POI could be an order block, a breaker block, a fair value gap, or any other significant supply or demand zone that you have marked on your chart. Think of it like this: the HTF POI is the crime scene. We already suspect that a reversal is likely to happen in this area. The SMT divergence is the smoking gun that we find at the scene. It is the final piece of evidence that confirms our suspicion and gives us the high probability signal we need to act.
The second professional filter we can use is a very specific time-based rule. We use the New York midnight open price, the start of the new trading day, as our key dividing line or daily equilibrium. This line divides our chart into two territories: a premium market, prices above the midnight open, where it is expensive to buy, and a discount market, prices below the midnight open, where it is cheap to buy. Our rule is simple and powerful. We only look for buy setups, bullish SMT divergence, when the price is in the discount market, below the midnight open. Conversely, we only look for sell setups, bearish SMT divergence, when the price is in the premium market, above the midnight open. This filter forces us to always buy low and sell high relative to the day's opening price.
By combining the previous rules, we can now define the low probability setups that we must learn to completely ignore. This is a critical part of a professional's discipline. In valid scenario 1, we see a perfect bearish SMT divergence, but it is formed below the New York midnight open. This is a sell signal appearing in a discount market. This is a low probability setup, and we do not touch it. In valid scenario 2, we see a beautiful bullish SMT divergence, but it is formed above the New York midnight open. This is a buy signal appearing in a premium market. This is also a low probability trap, and we ignore it completely. Learning what not to trade is just as important, if not more important, than learning what to trade. This discipline will protect your capital from countless unnecessary losses.
Now let's bring all of these filters together to describe the perfect A+++ SMT trade setup. Imagine this. 1. Time. We are trading above the NY midnight open, so our daily bias is bearish and we are only looking for sells. 2. Price. The price has just come up into a major pre-identified higher time frame supply zone. 3. Confirmation. At that exact zone, we witness a clear bearish SMT divergence form between our two correlated pairs. This combination of the right time, the right price, and the right confirmation creates an extremely high probability setup that we can trade with immense confidence. This systematic process of layering filters is how you transform SMT divergence from a simple observation into a powerful, robust, and professional trading strategy.
I've got an awesome gift for you. Right in the middle of this video, I've dropped 50 original and active ESET Smart Security licenses. No giveaway, no waiting. Just grab them if you're quick enough. First come, first serve. But before you rush to grab them, do me one small favor. Make sure to subscribe to the channel. Even if you're short on time now, you can come back later and pick up the codes. Just don't forget to hit that sub button. If you enjoyed this video or want more like it, leave a like and drop a quick comment. Your support keeps this going and helps me bring even more awesome stuff for you. The licenses are shown inside the video, so keep your eyes open, subscribe, watch later, will be useful one day.
Our entire lesson on SMT divergence was built on one fascinating premise. To predict the future of one market, you must sometimes listen to the secret conversations of another. We learned that SMT is an advanced technique based on spotting a, quote, disagreement, end quote, between two assets that are highly correlated and normally move in perfect harmony, like synchronized swimmers. The core theory is that when these two assets, which move together over 90% of the time, suddenly diverge, it is a significant event. It is believed to be the footprint of, quote, smart money, large institutions accumulating or distributing positions. By identifying this anomaly, we are essentially spotting the tracks of the market's most powerful players, giving us a powerful clue about their future intentions. This technique transforms our view from looking at one chart in isolation to understanding the interconnected story of the market.
We then discovered that this powerful, quote, disagreement can manifest in several different forms, each with its own level of significance. We learned to identify the hierarchy of power among them. The most powerful and strategic form is the daily high-low SMT, where one asset fails to break the previous day's high or low while its partner does, signaling a potential multi-day move. Next, we explored the session high-low SMT, a favorite tool of intraday traders for spotting traps at the open of the London session by comparing price action to the Asian session boundaries. We revisited the classic swing point SMT, the most common form seen between two nearby highs or lows. Finally, we zoomed into the most granular level, the candlestick SMT, where divergence can be spotted between just two adjacent candles, representing a hidden reversal on a micro time frame.
This part of our summary contains the most important warning of the entire lesson. You absolutely cannot and must not trade SMT divergence in isolation. A novice trader, after learning about these patterns, might excitedly open a chart and see divergences everywhere. If you try to trade every single one of these signals, you will be destroyed by 1,000 small losses, because most of them are meaningless noise. We must understand that SMT divergence is not a complete trading system in itself. It is a confirmation tool. It is a powerful piece of evidence, but it is just one piece of a much larger puzzle. To transform this observation into a profitable strategy, we must apply a series of powerful, non-negotiable filters to weed out the low probability setups and focus only on the A+ opportunities where the odds are heavily stacked in our favor.
The first and most critical filter for any SMT setup is location, location, location. A divergence only becomes significant and tradable when it occurs at a specific high-value area on our chart. That area is a pre-identified higher time frame point of interest, POI. Think of the HTF POI, be it an order block, a breaker, or a fair value gap, as the likely crime scene, where we already suspect a reversal might happen. The SMT divergence is the smoking gun that we find at this scene.
It is the final piece of evidence that confirms our suspicion and tells us that the reversal is likely happening now. A divergence that appears in the middle of nowhere, far from any significant HTF zone, is a signal that must be completely ignored. It lacks context, and without context, it is meaningless.
Our final filter is a brilliant time-based rule that adds another layer of probability to our setups. We use the New York Midnight Open price as our daily equilibrium or balance point. This line divides our trading day into a premium market, prices above the open where it's logically expensive to buy, and a discount market, prices below the open where it's logically cheap to buy. Our unbreakable rules are as follows. We only look for bullish SMT divergences, buy setups, when the price is trading in the discount market below the midnight open. Conversely, we only look for bearish SMT divergences, sell setups, when the price is trading in the premium market above the midnight open. By combining these pro-level filters, the right location, HTF-POI, the right time, premium discount, and the right signal, SMT divergence, we transform a simple observation into a complete and highly robust trading methodology.